Let me talk about and transition into reinsurance. And why do I say you have to know what you're doing? Anybody can buy reinsurance. Anybody will sell reinsurance. Brokers love to do that. And so, you want to go buy cat, you can buy cat. You want to buy risk, you buy risk. But do you know what you're doing and what you're buying? And I think, look, we talk a lot about it because it's an important part of our strategy. But we have Charlie Fry here in the front, best reinsurance buyer in the world. This is a very strategic part of our business, and it's different. I don't think there's any place in the world where reinsurance is bought by someone of his seniority or experience, and it doesn't come right to the group CEO. I mean, it usually goes into a business or goes into the CFO. It's not strategic, and it reflects in results. How do we think about reinsurance? Well, a lot, and we also think about the details that go into it. But we start with balance sheet protection. What's the financial impact? How do you reduce volatility and control it? It becomes more predictable. What's the gross underwriting strategy? Because you need to know what you're going to put into reinsurance. First, you need to know what you're underwriting. So having that correlation is really important. Your enterprise net underwriting strategy. And then you have to take a long-term approach to this, and you'll see how it's evolved for us. You can't buy it year to year and then change next year. This is all about building to reflect the portfolio, the strategy, and the execution. Now, people wanted me to take the slide out because sometimes it can be confusing, but I won, and we kept it in. So there's a few things here that I would just look at. One is if you look at just a gross portfolio, you have obviously much wider outcomes. And we see that in the industry with companies that take significant nets. You just don't know. So it's further to the right on the curve. If you buy reinsurance, it's to the left. And so therefore, it means that you have more predictable results. You're more likely to understand what the profitability is. Standard deviation's tighter. And you can never eliminate. The box reflects that you can substantially reduce tail risk by understanding your portfolio, modeling it, and coming up with a reinsurance strategy that is very thorough. So gross, you tend to have the theory, the academic exercise is you're ceding off profit. But that doesn't take into consideration real volatility that exists in the world and exists in terms of portfolios. So this is how we look at the enterprise. It's how we actually start modeling reinsurance. Back to 17 and looking at what reinsurance was purchased, what was the risk appetite compared to today, it's dramatically different, as you can tell. $1.5 billion net retention. That was a single occurrence, by the way, so if you blew through it, there was nothing left. We have $500 million in North America commercial. Japan, you can see the differences. Again, dramatic decrease in retention so we can control volatility. Rest of the world, they didn't buy reinsurance, so there's no real comparison. We like $125 million as a retention. And then we don't talk a lot about property per risk. That's an individual risk loss. But they could take up to $600 million net. We take 25 net. So it's just controlling that volatility. Now, if you said, well, reinsurance is expensive, and if you're buying more reinsurance, of course you have less volatility, but what does the cost mean? Well, it's a cost of goods sold. I mean, I always ask, never really get a good answer, but what's the difference between what you would buy in reinsurance versus what you ought to fund net? And a lot of times people change the subject because the answer is probably not much. And so I think when we look at this, it's a fully loaded cost that goes into our products, and therefore we know what the premium is going to be and what the expected margin is. Casualty, same story, if not even, I think, more dramatic. Well north of 100 net in the US historically. It's 12 million today. And in international, pick the number. You don't buy reinsurance. It's whatever the largest gross limit you put out. It was a significant exposure on an individual risk basis, but also on a portfolio basis. And that's sometimes what you've seen historically at AIG is just the volatility. And then in international, we have a $15 million retention. Look at the different return periods. And so again, I won't spend a lot of time on this slide, but what I will do is point out what I think is really important is that when we look at return periods, so 1 in 10 is frequency, 1 in 250 and beyond is severity and more tail. We did not structure our gross underwriting or reinsurance to any one particular return period. You can see it's consistent all the way through. which is best in class. That's what you want to do. A lot of times when you re-underwrite, you eliminate the tail. You may pick up more frequency. If you want to eliminate frequency, you end up picking up more tail. The gross reflects what the underwriting did. And so you can see at the 1 in 10, it was a 46% reduction in the PML, probable maximum loss. If you applied reinsurance, it was 70%. And so you can look at every return period and see it very consistent. And if you go to the 1 in 250, same story. Like it's a 43% reduction in gross, 70% reduction in net. That goes back to the chart that everybody wanted me to delete. Like you end up having better net retentions. You have better predictability of volatility, and you can see the substantial reduction in the portfolio during that period of time. This is for worldwide all perils. Casualty structure for reinsurance, just because I want to show you something that I think is really important for everyone to understand. We talked about international having a $15 million net retention. We buy $85 million in excess of that. It's 100% placed, so John Hancock, who runs international, him and his team issue a $100 million policy. Most loss we could have is 15. North America, the reason why it's 50x to 25, we don't deploy hundreds anymore. And if we do, we'll buy facultative. So we purchase a treaty to reflect the gross portfolio. So 50x to 25, and then we buy a 10x of 15 million, and we have a quota share to supplement that. So that's how you get to the 12 million retention. This is the only other slide that people didn't want me to put in, but I'll explain why I like it, I think. So be patient with me on this, but the 10x of 15, a lot of times insurance companies buy excess of loss to protect for vertical loss, which is a good idea. But what happens, because this isn't cat where you're not going to have, in today's day and age it could, but so many different catastrophes that you need 5, 6, 7 or more limits. In casualty, you might. So if you look at this, the 10x of 15 has $320 million of aggregate available. That means there's 32 reinstatable limits. And there's no APs. We pre-price this on casualty, so it's fully embedded. And if you hit it, you can hit it 32 full times and still have reinsurance available. The 50x of 25 for US, you have $525 million available. And then in international, you have $765 million of horizontal. So you have vertical protection and you have multiple limits that you can reinstate. Just think that's really important, because what it says up here is that extreme tail scenarios, companies tend not to buy at a return periods, they buy a couple limits. We did it in modeling at return periods. And I think it's really important to look at that and stress test it. So what does this all mean? I'll just give you an example. At the 1 in 250, which is already starting to become tail, if I actually had a bigger chart or was allowed to design this the way I wanted to, I could have brought it out to 1 in 10,000. That's where it exhausts. So at 1 in 250, you can just see that even if we hit that, which is starting to become extreme, we still have approximately 50% left in the international. We have 65% left in North America for the 50x of 25, and we have almost 50% left for the 10x of 15. So this is built for vertical and horizontal and extreme tail. I think it's very conservative. Can't really go into it in great detail on earnings, but I wanted to show everybody this because I think it's incredibly responsible, but also you'll now know why we're confident in terms of large losses. If there's things that happen to go different than that's modeled, we have unbelievable reinsurance protection. Let me give an example of a business, like what's happened. So North America excess casualty, we look at the total exposed limits. So if you look at the green boxes, that's the net premium written. If you look at the blue bar charts, that's the net we've had for each year. And then if you look at 2019 all the way out on the green line, that's the cumulative rate increase. And then the white line is the gross limit reduction. So the conclusion is that we started off with $243 million in 19 with a $12.5 million maximum net retention. And if you go all the way to 2024, what happened? 254% cumulative rate increase, gross limits reduced by 80%, and the net premium written is $474 million. Part of that's we readjusted some of the reinsurance, but most of it is through excellent underwriting, Barbara Luck and her team driving outcomes, and the business is performing exceptionally well. But you can just see, not only do we have confidence in the portfolio, the way it's been underwritten, we also have a lot of reinsurance protection and a very thoughtful strategy in terms of how we're going to position that business.